ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም።
ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ
በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ይቻላል።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና
ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና ባገኘንባቸው የፍላይት ኦፕሬሽን እና የሆስተስ ስልጠናም በምዝገባ ላይ ነን።
ጥያቄና መልስ፣ የክፍል ስራዎች ብሎም ፈተና መፈተን ክፍል ውስጥ እንዳላችሁ አይነት
ልምድ ባላቸው መምህራን እየተማራችሁ
በኦንላይን ባላችሁበት ቦታ
አድራሻ ከ22 ማዞሪያ ወደ ሾላ ገበያ በሚወስደው መንገድ 150 ሜትር ገባ ብሎ ናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
ህልሞን እውን ያደርጋል።
Good afternoon, everyone.
Good afternoon, sir.
Good afternoon, doctor.
Yes. Welcome to our today's class. I hope everybody's fine and doing well.
Yes, we are fine.
Okay. Yes, so I welcome you to this class. This is MBA Accounting. And if you recall, last week we discussed about we did various illustrations to illustrate ourselves on variance analysis, determination of cost, and budgeting issues to do with budgeting, the actual figures and the budgeted figures and the standard figures, and how you can derive a variance, and then from there you could now do the analysis of the variance that you found. We also said that it's not only the adverse variance or the unfavorable variance that you look for, you analyze, but you have to analyze also the favorable variance so that you come to understand exactly what's going on within your business and in terms of your sales, your pricing and all that. So it's very important that you as a manager, you keep appraised about the changing environment and how it affects your organization. Yes, so we did a number of illustrations just to help us internalize and appreciate why we take advantage of the cost classifications and cost determinations by the cost accounting systems so that the managers can utilize that information to make decisions. I also sent you discussions for today's meeting and we are introducing a new area which is Cvp analysis. Cvp stands for cost, volume, profit analysis. And why do we have to do this as managers? Because as much as we are making decisions about the past or historical performance, we should also be focused. I mean, be able to forecast the future performance. And this is why we have to do a Cvp analysis, the cost, volume, profit analysis. All businesses are there to make profits. So, and profit is actually a function of cost and sales. So when you talk about volume here, we are referring to the sales or the revenues, all right? So as much as we increase the revenues, we also strive to minimize the cost that we are incurring to generate those revenues. And that's why we are there to make decisions. We are there to make decisions about how do we minimize costs? How do we increase our revenues, all right? So volume here is relative. Volume is talking about the revenues that we are generating as an organization. Different organizations have different items that you would refer to volume or revenues. Assuming if it is a hospital, what would be revenue in this case? What is their core source of revenue? All right. If it is a manufacturing company and it manufactures and sells, what is their source of revenue? What is their core source of revenue? If it is a law firm, what is their source of revenue? So volume is relative as much as revenue is relative. So you look at the organization and then determine, or you have to check and see what is their core source of revenue. And mostly is derived from the core business of the organization. Because if you are there to buy and sell, then whatever you bought and selling is actually, when you sell, that is how you generate revenue. All right. So profit is now the revenue minus the cost we have incurred to generate those revenues. So the cost could be the production cost if you are manufacturing and producing products so that you sell, or production could be, for example, if it's a hospital, what are you incurring so that you offer your medical services, for that matter? If it's a bank, what are you doing so that you offer the banking services to your clients? If you are a lawyer, what are you incurring for you to offer the law services to your clients? So these are the questions that you need to ask yourself. You need to understand your organization very well, what their core business is, and their core source of revenue for this organization. Because if you try to maximize that, then in the real sense, you will also be trying to maximize our profits. If you try to minimize the cost that you are incurring with respect to our operations, then in a real sense, you're trying to maximize our profit, because profit is actually a function of revenue and cost that you incur to generate those revenues. So with that intro, I think I'll go straight away to the slides so that we go through the slides, and if there are any questions, we'll have a break as we go on so that you can bring on board your queries or your comments with regard to this area. However, this is a very important area for managers because the decisions you have to make are critical in this area, because the questions like how much do we need to sell so that we cover our costs? That's the break-even point. How much do we need to produce so that we can, or to sell so that we can cover our costs? Because of course, there are times when you are selling and you don't recover your costs. But when you sell beyond the break-even point, then you start earning your profit. So you must be aware of these facts as a manager, so that you plan for the profits that you're intending to make in the future. And these decisions actually help in the budgeting process, because for you to come up with a budget, then these are some of the things that you have to do so that you come up with an informed budget, because it's an action, a plan to what you intend to do in future. So if you want to step up your production volume, then that has to be planned for, because there are costs related to that. Of course, there are those like advertisement expenditures related to that, increase in the labor cost and all that. So these are issues that you need to be equipped with as you make such decisions. All right. So if there are any comments, please you can bring up before I proceed to the slide. Okay, so CVP analysis, cost, volume, profit analysis. Profit could be price, it could be price. Volume is the quantity, and cost is what you're incurring to sell. So it can be looked in that perspective, cost, volume, price analysis. And as I was saying, most decisions that you make as managers have, you're faced with the various options. And then you have to make a decision that is going to be viable for the organization, and the decision that is best decision for that particular time or at that particular time. So decision-making process involves selecting from a range of possible courses of action. So naturally, we are faced with so many alternatives. Like if you're an investor and you may have a wide range of investment opportunities. So you need to select which viable investment opportunity that you need to go with. And you don't just sleep and wake up and say, I'm not putting my money here. You need to have some analysis done for you to have a basis for investing in that particular investment and not the other one. So this is what managers do day to day. Before managers make their choice, they need to compare the likely effects of the options they are considering. So you need to look at the effects of the options that you are faced with. The effect can be assessed in terms of the costing. The effect can be assessed in terms of the sales. The effect can be assessed in terms of the profitability. All right. So among the other things that you look at is the cost-benefit analysis, which you have to do for various projects, and then select on one that is most viable at that particular time. So CVP techniques allows them to consider the consequences of particular courses of action. All right. So you can play around with this function. Of course, for example, if you know that fixed cost plus variable cost is equal to total cost, all right? If you increase the variable cost, of course, the total cost will also increase consequently. So you find that those are things that you need to play around with, so that as you try to, in science, we call it sensitivity analysis. You do a sensitivity analysis to see whether if you change this, what would be the effect, the overall effect on the other variables. If you change one variable, what will be the effect on the other variables? So you need to do a number of them, and realize nowadays the computer systems help us as managers to do this kind of analysis, and you don't have to take a lot of time. You don't have to think a lot, but as long as you feed the right information in your system, it will always give you the possible solutions. Now, the CVP seeks to provide answers to questions such as, for example, how many units must be produced and sold to break even, all right? Now, break even here is, what do you mean by break even? Break even is where cost is equal to revenue. So profit is zero. Break even is a point where profit is equal to zero. So anything that you make above the break even point, then you start earning your profit. All right. So you are recovering the cost you have incurred first before you start earning profit. That's why we say profit is the difference between revenues and the cost incurred to generate those revenues. So if you have a zero profit, then it means sales or revenue are equals to costs. Okay. So you need to know the number of units that needs to be sold for you to break that even. All right, because even is critical in decision making, so that you can plan and know that at any given time we should not sell less than this quantity in a given period. So we have to keep on increasing the sales, because if we sell less than or at that point, which you are calling the break-even point, then we are only recovering the cost, but you are not making any profits. So such information is very important for organizations and for managers in decision making. Then secondly, what would be the effect on profits if we reduce our selling price and sell more units? All right. There are cases when you can reduce your selling price so that you increase the demand for the product, and as you reduce your price, the demand increases, you end up selling more, right? So when you sell more, you tend to make more, even if it's little. You tend to make more sales. With more sales, then you are able to cover up your profits or make your profits. So such questions are critical for managers. If you play around with your selling price, that is through promotions. Promotions, organizations sometimes organize for promotions, and they sell their products at a price slightly lower than the normal price, so that people can be attracted to buy their products. And you find at the end of the day, you increase the volume of sales, and then you also increase the profits margins at that time. Then thirdly, what sales volume is required to meet the additional fixed charges arising from an advertising campaign? All right. You realize that the benefits of advertising campaign cannot be easily measured, but it has to take some time for you to measure the gains of advertising campaign. So the question of what sales volume is required to meet the additional fixed charges arising from. So it means if you are incurring more expenses, then it means your break-even point will also increase, because break-even point is a point where revenues are equals to costs. So when you increase the cost, it means the break-even point is also increased. All right. So the cost by increasing, then it means you need also to know the difference between the cost increment and now the revenue that you need also to generate for you to cover up these fixed costs. So these are some of the questions that help managers in application of this CVP analysis approach. Fourthly, should we pay our salespeople on the basis of salary only, on the basis of commission only, or by a combination of the two? All right. These are some of the things that you have to play around as a manager, so that you inform the board accordingly on what way to take. All right. Such questions like, if the salespeople are motivated they will work hard to sell more, and by selling more, you are making more profits, right? So such decisions are bound to be made at some point, because if you have to step up your sales, then you have to incur some cost for you to step up your sales, and such costs have to be incorporated in your planning process. So such questions are viable for this analysis, and of course, if you decide to pay commission, then commission is an additional cost which eats into the sales or the price of the product. Assuming your you're paying a commission. You're selling a product at $10, and then you are paying commission of $2 on every product that is sold, then it means your eventual return on that sale is $8. All right. So this cost has to be also be captured in your analysis process so that it's not ignored. Okay. So these are some of the questions that we ask ourselves as we try to apply this model. CVP analysis examines the relationship between changes in activity, i.e. output, all right, and changes in total sales revenue, costs, and net profits or profits. Later on, we are going to see the formulas that we use in coming up with these relationships, so that we're able to apply that in helping us make decisions. All right. So, so this information is vital. So it allows us to predict what will happen to the financial results if a specified level of activity or volume fluctuates. So we're able to tell, you know, what would be the cost effect if this one happens? If this variable is changed, what would be the net effect on all other variables? This is all about the CVP analysis. This information is vital to management since one of the most important variables influencing total sales revenue, total costs, and profits is output or volume. So the volume, which are now the sales, the quantity that you are selling, will actually affect the total cost, will also affect the profits, and will also affect the sales revenue. For you to, okay, so if you have to incur some extra costs, then you need to produce more or sell more for you to recover that cost. And that's why I said the break-even point is critical at any time, so that you can plan for what you need to sell so that you can start earning profit. Knowledge of this relationship enables management to identify critical output levels, such as the level at which neither a profit nor a loss will occur, i.e. the break-even point. Just as I had explained this, the break-even point, a point where we don't make loss or we don't make profit. So our profit is zero, our loss is zero, okay? CVP analysis is based on the relationship between volume and sales, revenue, cost, and profit in the short run. This is normally a period of 1 year or less, a time in which the output of a firm is likely to be restricted to that available from the current operating capacity. Okay, so as much as we are trying to apply this model of CVP, there are conditions which that CVP model can operate. For example, we are being told it has to be within a short term period, all right? Running within, this model can only work within a period of less than 1 year. If you have to make adjustments in your production level, then it has to be a decision that is made for that within that one period, short-term period. Because, for example, if you have to increase your capacity, it means production capacity, for example, it means you have to acquire probably additional machines, which requires a heavy outlay and which is a long-term kind of investment in nature. So you will have to, you can only play around with or make adjustments to what is within your reach, all right? What is within your reach. And now the long-term capacity increments can now be done later, so with time. So CVP analysis is only viable within a short term or a short run period, and that's when adjustments can be done here and there, so that you respond to the need as it comes. Okay, so it is very important that we understand this, and this is a key assumption in a CVP analysis model. It can only be applied in a short run period. All right, so in the short run, some inputs can be increased, but others cannot. All right. Additional supplies of materials are unskilled, and unskilled labor may be obtained at short notice, but operating capacity cannot be significantly changed. All right. Operating capacity is like acquiring additional machines. This cannot be easily obtained. But if it's an increasing labor force, that one can easily be availed. And of course, unskilled labor force, that can be easily availed. You can hire probably on commission basis when there is peak hours or peak times, and probably reduce when there is a low seasons. So, for example, it is not possible for a hospital to expand its facilities in the short run in order to increase the number of beds. Similarly, a hotel cannot increase the number of rooms in the short run to increase the number of guests. So these are examples of circumstances that explain why CVP analysis can only be applied in short run period and not the long run, because if you have to increase the number of beds capacity in the hospital, then it means you have to require a heavy outlay and time. Time must be there for it to be put in place. It requires capital for it to be put in place. So that the CVP analysis cannot apply to that. And you know the time value of money. So issues which will take a longer period of time cannot be applied in this analysis, in this model of CVP analysis. Note that most of the costs and prices of a firm's products or services will already have been predetermined over a short-run period. And the major area of uncertainty will be sales volume. Short-run profitability will therefore be most sensitive to sales volume. So this explains why we need to go for the short-run period. Profits are generally sensitive on the sales volume. So if you sell more, of course, you'll increase your profits. All right, and sales is something that you can easily change. Right? You can. It's dependent on external forces. Right? It may not be within your reach, but you have to do something extra for you to sell more than what you actually supposed to sell. So if you have to sell more, then there is a cost. There are costs that go with that, and these costs are now what you are analyzing as part of the CVP analysis. Profits are very sensitive on the sales volume in this case, and that justifies why we have to look at it from the short-run point of view. CVP analysis highlights the effects of changes in sales volume on the level of profits in the short run. All right. CVP analysis is dependent on the ability to estimate costs at different activity levels, and to do this requires that costs are analyzed into their fixed and variable elements. This is also another assumption that costs are we are able to analyze the cost in terms of fixed and variable. At this time, I'm sure we understand what fixed costs are and what variable costs are. Variable costs are costs that change with the level of activity. We increase the level of activity, we increase the variable cost. Fixed costs do not change with the level of activity. So I hope you recall that as part of our classification of costs. All right, now the assumptions of CVP analysis, as I said, any model will operate under certain assumptions. All right, that's why a good model sets the assumptions under which it can operate. All right, so just like any other model, it is essential that anyone preparing or interpreting CVP information is aware of the underlying assumptions on which the information has been prepared. One, all other variables remain constant throughout the analysis. And you realize that's why we have to do this thing in a short-run basis, not a long-term, because you don't expect variables to remain constant in a long run. But in short run, this is possible. We can have a price fixed, in a short run. But in a long run, that is not possible because you understand the economies are changing and all that. So you can fix your prices in a short term, but not in a long run. So this is a very critical assumption. It is assumed that all variables other than the particular one under consideration remain constant throughout the analysis. All variables remain constant throughout the analysis. So this assumption has to hold. Otherwise, the model will not be viable because one would say in a long run, variables are bound to change. They cannot be constant, all right, throughout. So that's why we are saying the short run perspective of application of this model is what is possible and not the long run. It is assumed that volume is the only factor that will cause costs and revenues to change. However, changes in other variables such as production efficiency, sales mix, and price levels can have an important influence on sales revenue and cost. Okay, so sales volume is critical here because you sell more, all right? You are able to cover your costs, you are able to break your even, and you're able to make profits. All right, so sales volume is critical here. You increase your sales volume, you're able to cover your costs, you're able to make profits. All right, so that's why we are saying it is the only factor that causes the costs and revenues to change. So if you sell more, you increase your revenues. If you sell more, you are able to cover your costs. So, and for you to sell more, you need to incur some costs. So these are the things that actually we are going to manipulate a lot when it comes to application of the model, the CVP analysis model. Now, if significant changes in these other variables occur, the CVP analysis presentation will be incorrect, and it will be necessary to revise a CVP calculations based on the projected changes to the other variables. Okay, so this is just a cautioning that if other variables like the production efficiency, if the production efficiency changes, all right, then the model probably may not work in this case because we are more supposed to focus on the output other than the input. Efficiency is part of the input, all right? But we are more focused on the cost that we have incurred at the end. We are more, or we shall incur at the end, the revenues that we shall sell at the end, and the profit that we shall make at the end, okay? If significant changes in this, all right, the CVP will be irrelevant. So it will be misleading because that is, production efficiency is a basic thing and thing altogether, which may affect the volume of sale or the cost of production, the volume of sales, and the revenues that we generate. But we are being told that CVP analysis cannot be applied in this context. Then secondly, a single product or constant sales mix. CVP analysis assumes that either a single product is sold, or if a range of products are sold, that sales will be in accordance with the predetermined sales mix. All right. So questions like how many units of product product A should we sell? How many units of product B should we sell for us to increase our sales? That's why we can look at it from a single product point of view, and then as much as from a more than one product point of view, the mixing of the product, so that and it all depends on the demand, or that is the sales that you're making per product. All right. So that's why we are saying the bottom line is the sales volume that will help us in making these decisions to do with the prices, the sales volume, and all that. When a predetermined sales mix is used, it can be depicted in the CVP analysis by measuring sales volume using standard bunch sizes based on a planned sales mix. So we can plan for a sales mix so that we know how many of product A should we sell, and how many of product B should we sell for us to make profits or maximize our profits. Any CVP analysis must be interpreted carefully if the initial products mix assumptions do not hold. Okay, so then number 3, total cost and total revenue are linear functions of output. So linear functions, it's a linear kind of relationship. The analysis assumes that unit variable cost and selling price are constant, as we had mentioned earlier, because that in the short run, that can only work in the short run and not in the long run. This assumption is only likely to be valid within a relevant range of production. So relevant range of production, which is most likely the short run range, within a short run range and not a long-term range. Profits, number 4, profits are calculated on a variable costing basis. All right. The analysis assumes that the fixed costs incurred during the period are charged as an expense for that period. The fixed costs incurred during the period are charged as expenses for that period. Yes, somebody talking? Okay, so Mosisa, can you mute your mic? Good. All right, so I was explaining the 4th assumption. The analysis assumes that the fixed costs incurred during the period are charged as an expense for that period. All right, so the fixed costs are, and variable costs are basically the production costs. So fixed costs are charged as expenses for the period. Then, therefore, variable costing profit calculations are assumed. If absorption costing profit calculations are used, it is necessary to assume that production is equal to sales for the analysis to predict absorption costing profits. Okay. Some of these assumptions, we'll understand them as we apply the model practically, and probably we'll be able to understand this. So, but what we are being told here is that we use variable cost to determine our profit. And that is now the contribution we're talking about, because if we increase the production volume, then it means you are incurring more of the variable cost than the fixed cost, because fixed costs are meant to be constant. They do not change. But when you increase your production, you incur more of the variable cost. So variable cost directly affect the profit than the fixed cost. And we'll see that in our application of the model. Then costs can be accurately divided into their fixed and variable elements. And we had mentioned this. We said for this model to apply, then we are able to categorize our costs into fixed and variable costs. Because as we are saying, variable costs actually have a direct effect on the profit. Because if we produce more, then we incur more of the variable cost, and fixed costs remain constant. So they're actually the marginal cost that we incur to produce more units. Cvp analysis assumes that costs can be correctly analyzed into their fixed and variable elements. In practice, separation of semi-variable costs into their fixed and variable elements is extremely difficult. Nevertheless, a reasonably accurate analysis is necessary if Cvp analysis is to provide relevant information for decision making. So for semi-variable costs, we always find a way of classifying them either fixed or variable. So it's important that we can break the semi-variable costs into fixed and variable, because that's when the model can work, but not with the semi-variable costs. Analysis applies only to relevant range, right? Short-term period. Cvp analysis are appropriate only for decision making or decisions taken within the relevant production range, and that is incorrect to project cost and revenue figures beyond the relevant range. Relevant range here is a period of less than 1 year, right? The short run period, and not periods going beyond. So the model can only be relevant within a short run period. Then lastly, we have the analysis applies only to a short-term time horizon. Cvp analysis is based on the relationship between volume and sales, revenue, costs, and profit in the short run. Typically a period of 1 year in which the output of a farm is likely to be restricted to that available from the current operating capacity. We had already explained that in our introduction. So during this period, significant changes cannot be made to selling prices and fixed and variable costs. So what you're being told is the first assumption we said the variables remain constant in the relevant range, all right? So we are assuming that price will remain constant in the relevant range. We are assuming that the selling price will remain constant in the relevant range. We are assuming that the fixed cost will remain constant in the relevant range, and the variable cost will also remain constant in the relevant range. But in case we are increasing our production, then the variable cost will change because they have a direct effect on the increase in volume of production has a direct effect on the total variable cost. Cvp analysis thus examines the effects of changes in sales volume on the level of profits in the short run. It is inappropriate to extend the analysis to long-term period for decision making. Long-term decision making. So that will not work for long-term decision making. It can only work for a short-term decision making. Before we go into the basics, I want us to probably give some comments or contributions towards the Cvp analysis introduction. We have looked at the assumptions and which needs to hold for the model to work. Any comments? Questions? Are you with me?
Yes. Yes. Yes, we are.
Okay.
Yes. Yes.
Yes. Yes. Any comments, questions?
Yes, doctor. Can I come in?
Yes, yes, sure. That's Bekele?
Yes, it's Sintayo Bakada.
Yes, yes.
You have been explaining 7 assumptions.
Yes.
For Cvp analysis to provide us relevant information.
Yes.
But I couldn't understand the difference between 0.6 and 0.7.
Okay.
Do you please elaborate? 0.6 and 0.7.
The sixth assumption
and the seventh assumptions. What's the difference between the two?
Okay.
Can you please? Thank you.
Yes, yes, I get your point. Any other comment or question or clarification? Ahmed, yes, good.
Doctor, as you told us, the Cvp analysis is only for short term, like 1 year, less than 1 year.
Yes.
So what will be the significance of a Cvp analysis for like managing a company? Because it will not be showing us the future. What will be the significance?
The significance, if it cannot be applied for long-term period.
Yeah.
Okay. Yes, yes.
I have also a question.
Yeah, Salesh.
Yeah. The third assumption, the total cost and the total revenue will have a linear relationship.
Yes.
That means the unit cost and the unit selling price will not be changed, for instance, for a year. Can we assume like that? Is it? Can you assume in such a way in practical world, because everything is variable, remaining constants for a range of 1 year will hurt or will not be a real.
Okay.
Will not be realistic.
Okay. The issue is for the model to apply, then we need to hold some variables constant. All right. So that was assumption 2. Probably let me go back. Then I'll come back to get more. Let me just share, because your questions are referring to some specific assumptions. The first question was asking about assumption number 6 and assumption number 7, the difference or the clarification on the assumptions. That was from Bekele, all right? Analysis,
Doctor?
number 6, analysis applies only to the relevant range. And I said the relevant range here is the period before, the period after the, now assuming that you are looking at the model or the relevant range. What is the relevant range in this case? Now, there's a period graphically. If you are to come up with a graph, and I wish I could have brought the graph here. If you come up with a graph, there's a time when you start producing, you have to incur some cost. Even at 0, there's a fixed cost that you have to incur. But the curve will go up until the point when you break even. That means you are selling and costs are equal. The sales and costs are equal. But then now, between that period, as you continue selling, you are increasing your profits. So the relevant range is the period under which you are making profits. Then that means now I need to come up with a graph probably to illustrate this. The period between when you're broken even and the period, because it has to go up, and then when it comes down, the cost supersedes. Because as you're increasing your sales, you are also increasing your production, but it cannot go all through. There's a time when it will come and the cost will overwhelm the sales, all right? So that you start making losses again. So the relevant period is the period between when you start making losses and the period when you start making profits. So that is the relevant range. So this means that the variables that you are measuring, we are assuming like the prices will remain constant within that period, the variable costs will remain constant within that period, and the cost will remain constant with that period. So that's the period we are to make decisions, all right? If we can play around with the pricing so that if we reduce our price, what will be the effect on our sales? All right, are we going to increase, to sell more? Then you have to, if you have to produce more to sell, then you have to incur more so that you produce more that you can sell. And again, the fixed costs, it reach a point when they will also change. So the relevant range is the period when the fixed costs are still fixed and they not change, because you cannot say you will continue producing forever without the fixed costs changing. So the relevant period is the period when the fixed costs will not have changed, or they will not be forced to change because of the increment in the production. So this is now the relevant period. And if you refer to the textbooks I sent you, you'll see some of these graphs trying to explain that. They are showing clearly the relevant period and the period that is outside the box. So the one that is relevant is that period when we can make such decisions. On number 7, the analysis applies only in a short-term horizon. All right, and this we had explained it in our introduction. We said things like increasing our capacity, our production capacity, like acquiring more of machines. These are things that are long-term in nature. They are things that you cannot change in a short notice. There are things that you cannot change in a short notice. That's why we are saying this model can only apply in a short-term horizon, in a short-term period horizon. All right, because if there are things that you cannot, even if you want to produce more, you cannot meet them within that period. All right, like if you have to buy more machines. The example we're given was if it's a hospital and they want to increase their bed capacity. That is an issue that cannot be changed or be done in a short period. It has to be something that has to be planned for. All right. So the model can only apply within a short-term horizon. I hope that is now clear, because it's actually enforced by the introduction that we gave under when we said the model can only apply in a short-term period because some variables have to be constant. I don't know whether I'm answering your question, Bekele. That was Bekele's from question. Yeah.
Yes. Okay. And thank you.
So I'll ask you to look at the graphs. I did not go into the graphs, but look at the graphs presentation. They show you the relevant range, the period when we start making profits, and it will go until the period when we start, the revenue curve goes down, slows down, and then the cost curve goes up. So that is the relevant period is a period within that period when we are making profits and when we start making losses. So we can make decisions within that period based on the Cvp analysis. The other question was from Mohammed. What is the significance of Cvp analysis if it cannot be applied in the long term? You see, every model, as I said, every model must have assumptions under which it can operate. Okay, and this is related to the explanation I was giving about assumption number 7, because if the fixed costs have to remain constant, that can only happen in a short-term period, but not in a long-term period. So for this model to work, then we are assuming that fixed costs are remaining constant. They are not changing. Okay, the selling price are not changing. If this model has to operate, has to be applied. So these are the assumptions under which this model can operate. If we violate this model, if we violate these assumptions, then the model will be misleading. The model will be misleading. Okay, so you know, some of these decisions that we make in the short term will end up benefiting the organization in the long term. Just as when we are looking at the budgets, we said we have a master budget and we have the flexible budgets. The flexible budgets are the ones that are done within 1 year. But the master budget is the one that now is broken down into these flexible budgets. So as much as you're making these decisions in the short run, they eventually work towards achieving the long-term objective of the organization. For example, how would you tell that now you need to increase your bed capacity? Because if you have to step up your profits, because these are decisions that you have to make in a short-term period, but you realize that there is a bed capacity that we need to increase our bed capacity so that we have more of the our customers admitted in the hospital, for example. So the short-term decisions that we make inform the long-term decision that we have to undertake. Because now the organization will be forced to invest into increment of the bed capacity of the organization. And this is informed by the decision that we make in the short run. So at the end of the day, as much as we are saying this model can only operate in a short run period horizon, it will also work towards the long-term period horizon at the end of the day, because successful short-run decisions eventually turn out to have a long-term benefit to the organization. Because if the bed increase capacity, if the bed capacities are increased, of course, we are able to increase more of our sales at the end of the day. So the decision to increase our bed capacity is informed by the short-run decisions that we make through the Cvp analysis. And this one, the increment of bed capacity is a long-term nature kind of a decision that we make. So I think as much as you are saying we can only apply this model in a short-run period, we are not saying that it is of no use in the long run, because it counts towards the long run decisions that we make. I hope there's a link there, Mohammed. Are we together? Mohammed? Mohammed is gone. Okay. I hope I've been able to link the two, yes. The long run and short run.
Yes, doctor, I'm here.
Yes, yes.
I'm available. Thank you, doctor. Thank you.
Yes, yes. The assumption number 2, somebody asked a question on assumption number 2, a single product or a constant sales mix. Cvp analysis assumes that either a single product is sold or a range of products are sold. You know, the organizations which, the organization, yes?
My question, is that for me? Yeah. My question is on assumption 3. Assume that for a given level of output, the sales price and cost, unit cost, the unit cost and the unit selling price will be constant in the short term. Will it be really, can you make that? Because sometimes the cost, the unit cost and the unit selling price will vary. It's beyond our control. There are so many conditions, even if it is within short time, like within a year, there are so many variables that force us to change the unit cost and the unit selling price.
Yeah. Well,
really, that was my question.
Yes, I agree with you, Celeste, wholesomely. But you know, every model has its own limitations as well. So this is a limitation of this model, all right? As much as it has the assumptions and it is useful in decision-making by managers, it has also its own limitations. And every model is like that. Every model has its limitations and its strength, all right? So if you look at the questions that we set in our introduction, which this model helps to answer those questions, then you appreciate the model. But again, if you look into the assumptions that they're making, you realize there are some weaknesses in those assumptions. Like now, what you're saying, all right? You don't expect profit, selling price to be the same throughout, all right? And now, this is where you come in as a manager. The profit for you to, you remember there was a question asking, let me take you back to the question. The key questions that, yes. How many units must be sold to break even? What would be the effect on profits if we reduce our selling price and sell more units? You look at that question. If, you know, when you reduce your selling price, you intend to increase the demand, all right? And that's one way of increasing your sales. But you see now, you are as a manager, you are the one to advise. Do we reduce our selling price? Okay. You are the one to advise. Do we reduce our selling price? Then you must do some sensitivity analysis, because as much as you reduce your price, you are reducing your profit if you are looking at it from a 1 unit perspective. But the more units, because if you increase you reduce the price, the tendency is you will sell more of units. And when you sell more of units, you tend to recover your costs. And when you recover your cost, the extras now becomes your profit. So you can take advantage of the volume. The total number of units that you are selling, the turning over is faster, all right, than probably selling the same product or smaller products or fewer products at the price that is currently prevailing. So the thing is, the assumption is the price is constant. But now, if you are the manager and you decide to reduce this profit, this price, what will be the effect on the overall sales, all right? These are now the sensitivity analysis I was talking about. You do the sensitivity analysis and you say, we can reduce our profit, but our cost must go up to, our cost can only allow, we can only allow our cost up to this level, all right? So then now you go back to the costing and see if we are to add more additional units, what would be the additional cost, the marginal cost that will incur for us to produce this number of units, okay? Then now you set the upper limit for production units, and then you can also reduce the price and then see how much you're going to sell and the eventual effect on the profits. So these variables, yes, the assumption is they are constant, but those constant variables are the ones now help you manipulate this linear equation. Because we know our linear equation is variable cost plus fixed cost is equals total cost, all right? And the linear equation is revenue minus cost is equals to profit. So these are things that as much as you increase, if you increase our cost, our sales increase, okay? And then now they meet at a point where they break even, and then now the excess now becomes your profit. So these questions are actually, when you look at them critically and look at the assumption number 3, then it will be able to help you understand that. Because the assumption is not likely to be valid within the relevant range of production. That's what is being explained, because profits are bound to change. I mean, prices are bound to change because you have to change price if you have to increase more, to sell more. Costs are, as much as you sell more, you increase your cost, okay? So some of these assumptions can also be interpreted differently and probably can turn out to be a weakness of the model. And as I said, every model has its own weaknesses and it is a strength. Okay, so
Thank you so much, sir.
yes.
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግ እና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
Are there any other comments? Probably I take up before we go back to continue to where we had stopped. There was Getachew, you raised your hand?
Yes.
Yes. Go ahead.
I joined lately. Maybe if I'm wrong, you can correct me. But I do have question on the time frame. How short is short? Because the break-even point considers fixed cost. In the long run, everything is variable. So how short is short? Thank you.
Okay. Who can help a friend who joined us late? How short is short? And that one came out clearly in the introduction. How short is short?
Maximum 1 year.
Maximum 1 year, yes. So you can do your analysis on a monthly basis. You can do analysis on quarterly basis, on half-year basis, on an annual basis. Okay, but what we are saying is you consider variables or items that can be actually changed within that period. And we gave an example of if it's a long-term kind of variable, for example, the efficiency, the production efficiency, that cannot be changed in a short-term period. It has to take some time for it to be changed, right? And then now, as I was explaining, these short-term decisions that you're making eventually inform the long-term decision that you have to make. So the short-term period is less than 1 year, as somebody has put it.
Thanks.
Any other question, comment? Okay, so yes, Gutu, yeah.
Yeah. Can we generalize that as the number of months or as the number of our analyzed increase, the accuracy of our CVP analysis will decrease? Can we say that?
The number of what?
As the number of or the range, time range increase, can we say the CVP analysis would the accuracy analysis would decrease? Can we generalize like that?
The number of range, if the range increase, the relevant range increase, the more analysis. And okay, so now it can be yes or no. And again, as you are saying, when you are just looking at one product, then you don't have to do a lot of analysis. And if you are doing more than 2 products or more than 1 product, then the issue of mix comes in. And then you'll have to do a lot of analysis because you have to do for every product and then a combination. You have to do for every product and then the combination. So more analysis is done when you are a wide range of product units. The organizations which are selling or deal in so many production lines, and they have different products that they are selling. So you find in such a scenario, the number of analyses that you have to do are more and frequent than if you are just dealing with one product. Okay. Then again, as a manager, you know, you have to be on toes every time. Probably you need to, because if you have to keep on. I don't know how to put it, but you know, you have to keep on learning. So how do you learn? You have to look at these variables every now and then. So you must have a way of getting this information on timely basis. And that's why the management accounting systems are there. So they give you this information, the performance in the market, how much you are selling probably on a weekly basis or on a daily basis. In fact, when you get information on a daily basis, then the better for this analysis to be done, because you can easily notice where there's a drop and where there is an increment, and play around with the analysis to determine the way forward. So the more analysis that you do, the better, right? And the more you are rich to the information that is required for you to do analysis, the better, right? So because you'll be on toes, you'll be in control, you'll know precisely what's happening within the organization and outside in the market about your products. Okay, so we can continue and look at the basics. Now the basics in CVP analysis, this is where we'll have to do now to understand some formulas. And these formulas will help us apply the CVP analysis model and be able to come up with the decisions according to what we are getting out of these formulas. Now, as we see, the model itself is cost volume profit analysis. So the analysis uses many of the principles of marginal costing and is an important tool for short-term planning. As we have mentioned above, it explores the relationship which exists between costs, revenues, output levels, and resulting profit, and is more relevant where proposed changes in the levels of activities are relatively small. The proposed changes are relatively small. Yes, small changes in the production activity levels are the ones, because it's actually short-term in nature, and that means that the shorter the period, the lesser, I mean, the shorter the magnitude of change that can be applied. Okay, the following are important in the CVP analysis. 1, profit is equal to revenues minus expenses. Okay, we know that from our accounting point of view, that profit is actually a function of cost, revenue and cost. So it's revenue minus cost will give you profit. So what are revenues? Revenues are inflows and other kinds of sales to customers. So what you sell to customers is now your revenues. And I said revenues here, the source of revenues can be relative, dependent on the organization and the core business of the organization. If you are, if it's a retail kind of business, whatever you are selling is now your revenue. Whatever you generate out of sales is your revenue. If it is a manufacturing setup, whatever you produce and sell is your revenues. And then expenses is also now the cost that we are incurring to make these sales. For example, to make these sales, to produce and make the sales. For example, suppose that the firm selling newspaper had $100,000 in revenue, 80,000 in expenses last year. What was the firm's profit? So the profit is actually the difference. All right, it's just as simple as that. We know that in accounting, for you to determine your profit, then you have to take the sales minus the cost of sales, and then the expenses as well. So expenses here, actually, it should be cost. Expenses are the periodic expenses that we incur to generate the sales, but they are also the production costs or the cost of goods sold, which are part of this. And for you to determine the profit is actually the total cost incurred production plus the expenses minus you less from the revenues to determine your profit. Investors love profit because it provides a simple measure of company's performance that is easy to understand. All right. It's easier when somebody talks about the company making profit. You can easily understand what the person is talking about. And this is the starting point for CVP analysis, because as I said, businesses are there to make profits. All right. So they all endeavor to do whatever they're doing so that they can make some profits. And you can see that the profit function, sales minus cost of sales and revenues. Then cost of goods sold. For manufacturers and retailers, cost of goods sold measures how much the company paid all right? Or will need to pay for inventory items sold. So cost of sales or cost of goods sold is actually whatever we incurred to generate the items for sale. It could be a manufacturing cost, if it's a manufacturing setup, or the buying cost of the goods that we are selling, all right? So all that count towards the cost of goods sold. To compute a retailer's cost of goods sold, use the formula outputs is equals to beginning inventory plus inputs minus ending inventory. In other words, you can state cost of goods sold is equals to cost of beginning inventory plus cost of purchases minus cost of ending inventory. So from accounting, we know this. To determine the cost of goods sold, we take the cost of openings inventory, we add the purchases, and we less the cost of ending inventory, so that we determine our cost of goods sold. Suppose that just the shoe shop started the season with 100,000 worth of inventory. So our opening inventory was 100,000. The company purchased, our purchases were 200,000. And the ending inventory was 50,000. So I hope we are able to see that, unless now you want me to share this. We can use this. So we are saying cost of goods sold equals to opening is equals to cost of opening inventory cost of opening or starting inventory, opening or starting. This is now the one that we started with at the beginning of the year. Plus purchases for the year minus cost of ending inventory. So opening cost of opening inventory, we're told is 100. Purchases, we're told is 200. Right, we less our closing cost is 50. So in this case, we have to work out this first, then we less this. Board mass, bracket of, so addition comes before the minus. So when you add this, you get 300 minus 50 which will give us 250. 250. $250,000. So that will be our cost of goods sold. Okay, that will be our cost of goods sold. And this one, it will also affect the revenue. We'll have to less from the revenues. And then there are those other costs which are calling the expenses, like the advertising, the salaries, all those are expenses, which also count towards the cost that we less from the revenue to determine our profit, our net profit. Okay. So you can adapt this formula to different scenarios. For example, suppose that your company makes rather than purchases the goods that it will sell. To compute cost of goods sold, replace the cost of purchases with the cost of goods manufactured. Okay, so what you're being told here, for a company that is manufacturing, we replace the purchases because purchases are goods that you are buying for sale. But when you are manufacturing, then we don't have purchases. Whatever we purchase are raw materials, all right, which are now converted into finished product. So it is the cost of opening finished, all right, finished goods. Finished goods, because the finished goods are the ones that are sold, are not the ones that are still in progress. Then here you replace with the so finished goods plus cost of production or manufacturing cost. Instead of purchases, you write cost of production. Minus cost of ending finished, all right? Ending finished inventory. Whatever we are selling is what is finished and not what is in process or work that is in process. So for manufacturing companies, this formula helps them to determine the cost of goods. So we are replacing the purchases with the cost of production because we purchase raw materials, we incur some cost to convert the raw materials into finished products, which are then sold. So it's the cost that we are incurring to convert the raw materials into finished products that you are referring to as cost of production. So you have to get the total cost of production, and then you add to opening production, opening finished inventory cost, and you less closing finished inventory cost. Okay, so that is what you do for a manufacturing company. So it will depend on the nature of the organization. So the formula is here. Cost of goods sold for a manufacturing setup, cost of beginning inventory of finished goods plus cost of goods manufactured minus cost of ending inventory of finished goods. Then we have contribution margin. Contribution margin. Now, what is contribution margin? Contribution margin measures how selling one item or a group of items increases profits. All right. To calculate contribution margin, we subtract variable costs from sales. So contribution margin is equals to sales minus variable cost. Sales minus variable cost. Now, variable costs, from our introduction, we know variable costs are costs that change with the level of output. Now, the assumption here, as we are looking at the CVP assumptions, the fixed cost is not changing, right? So it has no effect on the contribution margin. That's why we are only using the variable cost. So the variable cost, if you less from our sales, you are getting our contribution margin. Contribution margin helps managers by explaining how decisions will impact on profits. So we can use this to determine the effect of probably increasing sales, the effect it will have on our profit, or increasing production level or volume of products. When you produce more, what effect will it have on our cost, on our profit, sorry. So this is why it's important that we compute the contribution margin, and therefore the formula for that is given there. Contribution margin, okay, to compute contribution margin per unit, divide the total contribution margin by the number of units sold. The number of units sold. Alternatively, you can calculate sales price less variable cost per unit. So as much as you can get it in terms of the total cost and the total variable cost, you can also get it in terms of, in unitary terms, in terms of selling price, because selling price is per unit, and in terms of variable cost per unit. Okay, so I think you can, depending on what you're given or what you can get, you can use the unit way or use the total cost way and the total sales way. Now look at this example. If a given product sells $12 and has a variable cost of $9, so our variable cost is 9. This is per unit, and the selling price is 12. Then its contribution margin per unit is 3. So how do you get 3? It is actually the 12 minus 3. 12 minus 9, sorry. Okay. Now, for every unit of this product sold, increases profit by $3. So that means for every unit that we sell, our profit is increased by $3. All right. So again, we can also compute the contribution margin ratio. The contribution margin ratio, or CMR, is equals to total cost, total contribution margin, over total sales. So you can also look at it in the unitary terms. Contribution margin ratio is contribution margin per unit, which you can also compute over sales price per unit. Sales price per unit. Okay, so for a given example, if a given product sells $12 $12 and has a contribution margin per unit equals to $3, then its contribution margin ratio is equals to 25%. That means the contribution margin per unit, which is 3, over total sales, which is 12, you get your 25. So you can get it in terms of percentage, and this will be 25%. So if it's terms of percentage, then you just multiply by 100. Then you express it in there. So this result means that every dollar of sales increases profit by 0.25 or 25%. Okay, let me show this. Now we said contribution margin. Is equals to selling price minus variable cost per unit. Okay, our selling price, we've been told, is 12. Is 12. And our variable cost per unit we've been told it's 9. So our contribution margin is equals to 12 minus 9, which gives us 3. So the formula the example we've been given requires you to apply this formula. But there are circumstances when you are given the total sales. For example, if you are told the selling price and you are told the sales, you are given the sales as the total figure, and then the variable cost, total variable costs that were incurred, then you just use the figures to get your contribution margin. So you can also, as much as this is the contribution margin per unit. So the contribution margin per unit is the $3. You can also determine the total contribution margin if you are using the lump sum figures. Then you are told you can also determine our contribution margin ratio. Contribution margin ratio. So it's given us the contribution margin per unit over selling price per unit times 100. So this is 3 over 12 times 100, which gives us 25%. So 25% is our contribution margin ratio. Okay. So you can use this ratio to project, just like what you are doing with the cost function, right? Y is equals to F plus Vx. So you can use this ratio to project the future profits that you intend to make. And we'll see how we can make use of this information to predict our target profits, to predict our sales and all that. Any questions? Any questions on contribution margin?
Doctor. Hello,
Yes.
Doctor.
Yes.
Just not a question directly related with the contribution margin, but
yes.
Don't you think that we need like 5-minute or 10-minute break in this 2-hour class? I think it's too long to concentrate the whole class. So I think we need just 5 minutes or 10 minutes break.
Now, that was Mohammed or who?
Yeah, Mohammed. Yes, Doctor.
Mohammed, you're feeling sleepy.
No, I didn't feel sleeping, but it was difficult for me to concentrate, Doctor.
It's difficult to concentrate. Anyway,
yeah.
That's why I take a break in between, so that if there are any comments, any suggestions, any questions, you can air them. Then we respond to them, and that keeps you active, right? Yeah. So I've taken a break. Now we can bring in your contributions or suggestions or comments.
I think, Doctor, the contribution margin part is a very important part, especially in production.
Yes.
It's not that matter what we said, but which part of our production or our efforts brings profit to us. That's the important thing, I think. So if we know which part of our production or effort bring us more profits, we should focus on that, and we should produce and put more effort on that. So this calculation is very important.
Precisely. And that's I can see you're already appreciating the model, isn't it? You're already appreciating the model, the CVP analysis model. It can tell you where are the profits highest, isn't it? So if you have a different products, all right, you can do for each product, and then now you can establish which one is bringing more profit than the others, and then you can make a decision whether to drop the non-performing one and maintain the performing one, and vice versa, or see how we can improve on the one that is not making desirable profits. You see how to improve so that it makes more profits. And now these are the games that we are going to play with the CVP analysis. That's a very good observation. Contribution margin is a very important item in the CVP analysis. Probably you can do for a product, even if you're dealing in a single product. You can do for a mix of products, isn't it? So you do for each, and then you also assess the combination. If you combine the mixing, All right. Using the contribution margin, you're able to come up with a viable or optimal mix structure that you need to hold. Any other comment? Okay. So I think we have around it's already 4. Okay. So I think let's take a break for today, and then tomorrow we'll finish on those basics, because there are also other basics that we need to understand, as I'd given you. And then from there, we'll go into the illustrations and see how we can apply some of these basics in helping us make decisions in a given scenarios, different scenarios that you may be faced with, and see how we can come up with the viable solutions to the problem that is at hand. Okay, any comment? Now, I beg to stop there for today. We meet tomorrow, as usual time, to continue from where we have stopped. And yes, thank you so much for turning up.
Thank you, Doctor.
And hope to see you again tomorrow in good time.
Bye, Doctor.
Thank you, and have a good evening.
Doctor. You too.
Thank you,
Thank
Doctor.
you.
Bye.